Gold just did the opposite of what everybody was expecting. War is raging, uncertainty is on the rise, yet gold is selling off. Should it be the opposite? When things get uncertain, when oil prices go up, when risk on assets sell off, gold should be the safe haven, but that's not what's going on. The official narratives don't work anymore. It's not when stocks are going down that gold is going up, that we can simply have a diversified portfolio and something will go up all the time. Times have changed. In this video we're going to look at the factors that actually drive prices. Because from the all-time high, gold has already lost 18%, silver has lost even 41%. And that's all happening while the oil price increased by 84% in the last weeks. And we all know the reason for that price increase. Here is what I think is going on. I believe that enough people have already prepared for a scenario like this. Gold and silver rallied massively in anticipation of a further devaluing US dollar and in anticipation of a potential crisis. This could be war, this could be an economic crisis. There were already quite a few signs that were showing that the economy isn't as healthy as it first seems. Now, I like to look at relative valuation data. I don't like to look at data just measured in US dollars. If we look, say, at the gold price over the last 100 years, or we look at the S&P 500 over the last 100 years, the US dollar chart doesn't give us any information because the US dollar is devaluing over time. The US dollar base grows by roughly 6.8% per annum, and so any asset that keeps its value is expected to grow by 6.8% per annum. Really, we have to compare assets. This way we see where the money is actually flowing. Now this here, that's the gold price relative to the S&P 500. So how is gold, the leading precious metal, performing versus the leading stock market index? This is a very long-term chart. It's 140 years of data. It starts in 1891. And sometimes gold outperforms, sometimes the S&P 500 outperforms. And those cycles are quite long in duration. So this over here is 37 years of data, and they're also quite strong in magnitude. From here to here is a decline of 92%. From here to here is an appreciation of 1,500%. So those kinds of capital movements, they do matter, and they are cycles that are very long term. Now, over all of those years, gold did underperform the S&P 500 by 81%. But unfortunately, our life expectancies are not more than 100 years. So we have to work with the cycles. We can't just say gold underperforms stocks long term. We have to play the game of timing the market. Because what does that long-term underperformance help? If you're holding stocks over gold, while gold outperforms by several 100%. Now in this chart, gold doesn't look very cheap. It might have some additional upside of maybe 40%, but it also has downside of 73, potentially even more percent. Now there are two ways to look at this chart, either through this lens of a long-term declining gold price, or we could work with maybe that both gold and the S&P 500 are just long-term competing asset classes, and they should move in tandem with each other. They did perform the exact same over the course of 90 years. That's a data point from here to here. Or have a look at this. This is from 1929 to today. That's 97 years. Again, the cycles matter much more than the long-term trend. The dotted line here, that's the long-term equilibrium. So what was on average the price of gold versus the S&P 500? With that perspective, we could see outperformance of gold of another 125% versus stocks. Now, when gold outperforms the S&P 500, that doesn't necessarily mean that the gold price has to go up. This can also mean that stock prices fall by 50 or 60%. What's more likely right now? I don't have a crystal ball, but I like to look again at the long-term valuations. If something long-term is very expensive, it's more likely to become cheaper again. If something is long-term cheaper, it's more likely to go up again, irrespective of the news. Again, medium-term, the news seem to not matter that much. We've got war and still the gold price drops. When gold outperforms the S&P 500 by more than 100% or by around 40%, then I think that outperformance will mainly come from the stock valuations declining. This here is the long-term price to earnings ratio of the S&P 500. It's the Shiller PE ratio. It's an average metric of how expensive stocks currently are. When we buy stocks, we buy ownership in a company, and a company produces cash flows, produces earnings. How much we pay for that company relative to its future earnings. That's the PE ratio, the price to earnings ratio. So really, it's a clear metric how expensive currently stocks are, how much the market anticipates earnings to grow over time. Again, a very long-term chart. It starts in 1871. This was the Great Depression and the hype that happened prior to that Great Depression. Here is the dot-com bubble burst and the hype that happened prior to that burst. Then this year is the global financial crisis. Bitcoin was created over here in 2009, and we're currently at very similar PE ratios to the height of the dot-com bubble. If stocks were to drop by 50% from here, then we'd simply go back to long-term regular valuations, and then gold, relatively speaking, would be outperforming. And so that's really my base case. When we look at the S&P 500 relative to the US money supply, we also see how stocks are very expensive. So we don't just have the Shiller PE ratio, we also have the S&P 500 relative to the money supply. This here is .com. This is our current level. The vertical line, that's when Bitcoin got created at the beginning of 2009. This here, that was .com. And this year, that was the global financial crisis. COVID can barely be seen on this chart. It's this dip over here. Now, there's a very important takeaway with those charts. Relative valuation charts look at opportunity costs, as in, should we be invested in gold or in stocks? Should we be invested in crypto or in bonds? What should we actually allocate our capital to? It is not a perspective of should we be in cash or in an asset. Cash over the long term tends to go down. Being just in fiat currency is a bad idea, but being invested in the right asset class is extremely important. Just because an asset outperforms just holding paper money doesn't make it a good investment. It's always about what investment should we be over allocated to, what investment should we rather avoid. And so yes, gold versus the S&P 500 could potentially appreciate, but it's mainly because the S&P 500 is likely going to go down. I don't have a crystal ball, I'm just presenting the data that I'm seeing. I believe that gold has already hit peak valuations. I think that this sell-off, it is long-term profit taking. Even extremely bearish news around the world economy isn't enough to push the gold price higher. And here's why. Have a look at the gold price relative to the US money supply. This is the rally that started 4 years ago. Gold from bottom to peak outperformed by roughly 200%. And this dotted line over here, that's the average ratio of gold to the US money supply. So if the gold price was to go back to its equilibrium, it could fall by 40%. And that's now relative to a constant money base. So if there was no expansion of the US dollar, if there was no devaluation of the US dollar, gold might do better than the S&P 500, but it might go down versus fiat currencies as well. The real problem is not that equilibrium line, because that line suggests that gold can always keep 100% of the purchasing power over time. I don't think it does though, because gold itself also expands in supply. Not as quickly as fiat, so fiat currency grow by roughly 6.8% per annum. Gold grows by roughly 2% per annum. So there's gold being mined out of the ground. And so the gold base grows by roughly 2% per annum. So really, we should expect the purchasing power when we invest in gold to go down by 2% per annum. In fiat, it goes down by 6.8. In gold, it goes down by 2%. That's why gold measured in fiat over the long term goes up. But we should not expect gold to keep 100% purchasing power. This here is too optimistic. When we measure this peak over here and this peak over here, we've got a decline of roughly 58%. That's over the course of 47 years. If we take a 2% devaluation and compound this over 47 years, we are left with 39% purchasing power. So that's a drop of 61%. And that's pretty much what we see here, right? It's not 61%, it's 57%. But really, if we were to draw a chart of the gold market cap relative to the market cap of US fiat, right? So relative to US M2, then those two tops would align quite well. So really, the top that we've seen recently, it's very comparable to the top of 1980. And that's why I believe, even with all of that uncertainty, even with the war in Iran, gold cannot appreciate more. It has already been bought way too much. This peak is the same as this peak. Now, the big problem with traditional finance is that the cycles are very, very long. So with crypto, we know that if we buy at the wrong time, let's say we buy Bitcoin at the cycle peak, we can potentially wait it out. We can potentially just wait for 5 or 6 years and we get bailed out. Bitcoin will recover relatively quickly because it's very volatile. Now, in traditional finance, that's not necessarily the case. If your time horizon is not 100 years, if you are not saving in order to give this to your grandchildren for inheritance, if you're actually saving for your own children or maybe for yourself, then you have to ride the waves. You have to time the market. Have a look at gold relative to the money supply. This bottom to this bottom here, that's 30 years. If you're buying gold at the cycle top and you're just buying the dip as it goes down, it continues to dip. It continues to dip longer. You're waiting until you're getting old to hopefully get a slight recovery at some point. But then are you really going to enjoy the fruits of your labor 30 years down the road? I doubt it. Have a look at the S&P 500. This top to the recovery, that took 36 years. Or the .com peak to today, that was 26 years. So really, measured in fiat currency, yes, buying the dip makes sense. It makes sense to be invested, to get rid of fiat currency very quickly. But doing this always just with one asset class, just buying, say, the S&P 500 or just buying gold because gold dropped, that's not necessarily that smart. It's much better, in my opinion, to move between asset classes, to figure out where currently the trend is headed. And those trends are very long term. They don't change every year, and it seems like the bull market for stocks could potentially come to an end. We might see another lost decade as we did in the 2000s. And gold might not be the best safe haven because that's already been bought too much as well. Now, unfortunately, there's no easy solution to this problem. When gold is expensive, when stocks are expensive, what can we actually buy? Property also doesn't have great yields. We've got demographic changes, so there might be also an oversupply of housing. Really, it becomes trickier and trickier to preserve purchasing power over time. We have to play more advanced games. We have to bet on falling prices, for example, and diversify that way. That's at least what I'm doing. I'm trying to find out where are the biggest bubbles, what's most likely going to deflate, who's going to be a loser in all of this, and I'm simply making money that way. I'm not trying to find the few winners, I'm rather betting on the overall trend. Fundamentally, it makes sense that it becomes harder and harder to grow capital over time because capital is already that much concentrated in a few hands. There's less and less productive capacity relative to the demands of that capital. If financial assets on average grow by, say, 7% per annum, but the economy only grows by 2 or 3% per annum, that gap, that delta, the 4%, this is simply just redistribution from the productive side of the economy to the capital holders. And of course, if this happens year after year after year, something in the system has to break. And I think we are pretty close to something breaking. And it's not easy to figure out how this will unwind. Who's going to be the bag holder? Who's going to lose most in this new system? Still, I'm trying my best to grow my own capital as well. Against all odds, I expect that most people that currently have money will lose a lot of it in the next years. But if we follow strategies that most other people aren't following, at least we've got a chance to still win. I'm sharing my own portfolio. I'm showing my own investments and trades in the premium membership that's down in the pinned comments. If you got some value out of this video, feel free to give it a like. If it's your very first time here, feel free to subscribe as well. I publish videos regularly. See you next time on YouTube or see you on premium. Cheers.